right, then in A2, you need to calculate the budgeted variable costing profit or loss by reconciling the absorption costing profit to the variable costing profit or loss. All right, guys, so if you go back to the information provided in the scenario, you'll remember we said this statement over here, or this budget that you were provided with, has been prepared using absorption costing. So that means this is the absorption costing profit. So what we need to do is we need to calculate the variable costing profit or loss using the recon. So remember, if you go back to your lecture, the logic behind the recon is we are going to start with this absorption costing profit. So there's the absorption costing profit. You need to add any difference in opening inventory, deduct any difference in closing inventory, and that will give you your variable costing profit or loss. Now, in this question, we know that the company doesn't have any opening inventory, so there's no difference in opening inventory. Then the easiest way to calculate the difference in closing inventory. Remember, guys, if absorption costing is used, then both fixed and variable manufacturing costs are included in the value of inventory. On the other hand, if variable costing is used, then only variable manufacturing costs are included in the value of inventory. So regardless of whether the company uses absorption costing or variable costing, variable manufacturing costs are always included in the value of inventory. So the only difference between the two is the fixed costs. With absorption costing, we include the fixed manufacturing overheads in the value of inventory. However, with variable costing, we do not include the fixed manufacturing overheads in the value of inventory. So the difference between the two is the fixed costs in closing inventory. And that is the easiest way of performing this calculation, because we already calculated the fixed overhead allocation rate. It's 11 Rand 32 per unit. And we know that because it's company policy to keep 10% of units produced in closing inventory, in the first year, they should have 4,400 units of jam in closing inventory and 2,300 units of chutney in closing inventory. So we can calculate the fixed costs in closing inventory. For jam, it's 4,400 units multiplied by 11 Rand 32. And for chutney, 2,300 units multiplied by 11 Rand 32. Those are the fixed costs sitting in closing inventory, and that's the difference between absorption costing and variable costing. So you deduct the difference in closing inventory, and that gives you a variable costing loss. Then you can see as an alternative, instead of calculating just the fixed costs in closing inventory, you can calculate what closing inventory would be if absorption costing is used versus what closing inventory will be if variable costing is used. And you can then calculate the difference between the two. And obviously, you can see, guys, you come back to exactly the same answer. Let's just quickly have a look at this calculation. Obviously, guys, if absorption costing is used, then we need to include both fixed and variable manufacturing costs in the value of inventory. So if absorption costing is used, that is your product cost for jam and for chutney. So the product cost for jam multiplied by the number of units in closing inventory, the product cost for chutney multiplied by the number of units in closing inventory. So that's what closing inventory would be if absorption costing is used. On the other hand, if variable costing is used, then we should only include variable manufacturing costs in the value of inventory. So for jam, it's 35 Rand per unit multiplied by 4,400 units, and for chutney, 25 Rand per unit multiplied by 2,300 units. So that is the value of closing inventory if variable costing is used. And you can then just calculate the difference between the two, which is taken into account in the calculation above. So you can see if variable costing is used instead of absorption costing, we have a loss and not a profit. Then next you need to explain why closing inventory is deducted from the absorption costing profit to arrive at the variable costing profit or loss. All right, so that's the calculation that we just looked at over here. We deducted the difference in closing inventory. what is the logic behind deducting the difference in closing inventory? So to help with this explanation, I've just drawn up an absorption costing statement. So this is normally what your absorption costing statement would look like. Now, remember, guys, what we are trying to discuss is why is the difference in closing inventory deducted when we are reconciling the absorption costing profit to variable costing. So this is my absorption costing profit, and we need to reconcile that to the variable costing profit. All right, and what is the logic behind deducting the difference in closing inventory? Why do we deduct that difference in closing inventory over there? So let's look at the logic of this. Guys, if we are using absorption costing, that means that both fixed and variable manufacturing costs are included in the value of inventory. So if absorption costing is used, closing inventory will be higher than what it is if variable costing is used. Because if variable costing is used, we'll only include variable manufacturing costs in the value of inventory. With absorption costing, we also include fixed manufacturing costs. So with absorption costing, closing inventory will therefore be higher. Now, when we calculate cost of sales, we deduct closing inventory. So if closing inventory is higher, that means cost of sales is going to be less. So if we are using absorption costing, cost of sales is less than what it would be if we were using variable costing. Now, if cost of sales is less, so your expenses are lower, it means your profit over here is going to be higher. So it means that the absorption costing profit is higher than the variable costing profit because of these fixed manufacturing overheads that are being included in the value of inventory. So if we want to calculate the variable costing profit, we therefore need to deduct the difference in closing inventory because this absorption costing profit is higher and the variable costing profit should be lower. Then just to make sure that you understand this properly, there was no opening inventory in this question. So the discussion around opening inventory does not form part of the suggested solution, but you will see that I have included it in the suggested solution. And you know from our recon, if we are trying to reconcile the absorption costing profit to the variable costing profit, we add any difference in opening inventory. So let's just look at the logic behind that. Why do we add the difference in opening inventory? We've discussed the reason why we deduct the difference in closing inventory. Now I want you to also understand why we add the difference in opening inventory. So please note once again, guys, this does not form part of the suggested solution. It's just for learning purposes. If absorption costing is used, we include both fixed and variable manufacturing costs in the value of inventory. So opening inventory will be higher if absorption costing is used. It will be lower if variable costing is used because we only include variable manufacturing costs in the value of inventory. So with absorption costing, opening inventory is higher. So if opening inventory is higher, cost of sales is going to be higher. And if cost of sales is higher, remember that's an expense, then profit is going to be lower. So the absorption costing profit should be lower than the variable costing profit. Or another way to look at it is the variable costing profit should be higher than the absorption costing profit. And that is the reason why we add the difference in opening inventory. You take a lower amount, you add the difference in opening inventory to get a higher amount. Then in part A4, explain how it is possible for Jane to forecast a profit of 59,780 Rand when expected sales are less than the break-even point. All right, so let's just first make sense of the required over here. If you go back to the information provided in the scenario, we can see that Jane is forecasting a profit of 59,780. We also know that the break-even point is 61,098 units, And if you go back to part A1, all of the calculations in part A1, we calculated the total budgeted sales. Total budgeted sales are 60,300 units. So make sense of the required. Jane is budgeting to sell 60,300 units, and she's calculated that the break-even point is 61,098 units. So she's budgeting to sell less than the break-even point, which means she should make a loss. So how is it possible that she's forecasting a profit if she expects to sell less than the break-even point? Once again, I just want to use the format of this statement over here to explain the logic to you. So you guys know that when absorption costing is used, these production costs over here include both fixed and variable production costs, which means closing inventory includes both fixed and variable production costs. So it's important to note, guys, we calculated in part A1 that this fixed production cost over here is budgeted to be 758,600. But included in closing inventory, we have fixed costs of 75,844. How do I know that? If you go back to this calculation over here, these are the fixed costs that are sitting in closing inventory. This was calculated in part A2. The fixed costs in closing inventory, 75,844. Okay, so included in closing inventory over here, we have fixed costs of 75,844, and included in our production costs over here, we have the total budgeted fixed cost, obviously, for the year. Now, it's important to note, guys, that when we calculate cost of sales over here, closing inventory is deducted. We take production costs and we deduct closing inventory. So that means this full fixed cost is not being expensed in the period incurred. What's happening is part of this fixed cost is not being treated as an expense. Instead, closing inventory sits as an asset on the statement of financial position. And this amount is only going to be expensed in the next period when it gets added back as opening inventory. So for now, this amount over here hasn't been expensed. It will only be expensed in future periods. On the other hand, if variable costing is used, we don't include any fixed manufacturing costs in the value of inventory. So what happens is the full fixed manufacturing cost is expensed in the period incurred. So that's why when we performed this recon, we saw that if variable costing is used, the company forecasts a loss of 16,054 Rand. And it's important to note, this is the difference between absorption costing and variable costing. And cost volume profit analysis is consistent with the principles of variable costing. So, if Jane had prepared the budget using variable costing instead of absorption costing, she would forecast a loss of 16,054 Rand because she expects to sell less units than the break-even point.